Steve Miller. Get ready for Steve. He's an excellent technician, very thoughtful market tactician as well, and great to have you back, Steve.
Hey, it's great to be here, Dale.
Yeah, it's been a while, and you went through COVID and you were traveling, and
Yeah. It's we were out back in Chicago when the last time, and I had to cancel with you because we got
yeah,
COVID, my wife
yeah,
and I, and it was actually had it for like a month, and
wow,
but now
yeah.
we're getting back and recovered.
All right, buddy. Well, I'm very interested in what you're seeing. We're approaching fall here, and seasonally, if I was correct, I think you were looking for some type of top the last time we talked in the June, July timeframe or something like
Yeah,
July.
actually, the beginning of the year, we called this year, 2022, a bear market year for the stock market, and of course, that has certainly been correct.
You
And
want to share
actually,
your screen,
sure,
bro?
sure.
See
Let me
some of those
get the
charts.
screen up here, and you should right now see my S&P chart. This is going to look messy and foreign to a lot of people. Can you see that?
Yeah, I just had a flashback to in my college days.
Yeah. Well,
Go ahead.
let me just very quickly spend just 30 seconds to explain what kind of a chart this is. You'll notice on the bottom, these are called cycle brackets. We're cycle analysts here at Ask
Right.
Slim, and what we look for is the energetics in the market. Essentially, this is the ideal energetics, these cycle brackets on the bottom, and how they actually resolve in real cycles is just phenomenal because you can see the movement in here as it follows the energetics on the bottom.
Yeah.
And once you get what's called a negatively configured cycle, like right over here, we had a good idea that we had a top in place. So I'll zoom in on this so you can get an idea of to where we are right now. And we had anticipated that the market would be negative through the third quarter of this year and then get into a more positive period. Now, these yellow areas here are where the greatest period of risk are. That is when the minor cycle and the dominant cycle nest, and that's where you
Yeah.
get the biggest downside movement. And you can see that's where we are right now. So we
Okay.
had believed that these little upside rallies that we've gotten, and the one we had last week was super intense. When you talk about 4 days of 230 points in the S&P 500, that was, very intense. And then it gets up into the resistance zones and fails. So I'm going to move from the weekly chart here to the daily. A lot of people follow daily more. And you can see in here on the daily chart, the same type of cyclicality. Those yellow zones bring the areas of the largest downside risk. And when you get a daily chart that's aligned in this negative period, just as the weekly chart is, that's when you really have a lot of downside risk. So we're anticipating that the market break that we had off of this little island or abandoned baby after that 230-point move is likely to continue down through towards the end of the month. So the fairly high probability that this low is going to get taken out, you can see that already down at this
Right.
38.86 area. There's some support right over here around 37.76, but there's a chance to get back down to that 36.36 level, which was the low that we made in June. And there's a pretty good chance at that. So the next 2 weeks have a lot of risk in the stock market. I think any kind of a little rally attempt in here will be met with a lot of selling on the downside. A lot of risk now in the stock market. And
Okay.
I think the
Like that.
lows for the year are probably going to be made here in these next couple of weeks, and then a little better time, an uptick, let's put it that way, in what is, I think, an ongoing bear market.
Okay. So another bear market rally after this flush.
Yeah, but I think it'll be a little bit more than, and last longer than these 4 or 6 day upticks than we've had. I think it'll be quite a number of weeks.
Okay. Maybe into the spring.
Doubtful that it's into the spring because there's another, I'm going to go back to that weekly chart. There's another important low coming out over here. So that comes out into March. And I think that could be a time period where the market is getting hit very hard again. You can see the note here. Our members get these live charts. So out here in March, April is more likely a bear market low.
Okay, interesting. Into the solstice,
Well,
equinox.
I don't follow that, but if you say so.
Okay, well,
Yeah.
you have some things right here. We're near the fall equinox coming up here, and right around your 926 date.
That's
Within
correct.
5 days.
926
So
is that
okay.
is the mid range of that date. These two vertical lines right here on the daily chart are basically the cycle range where we expect the low to fall into that time frame.
You know, I'm curious, Steve. I'm seeing some a decent pattern, plus sentiment is so negative on bonds here. I'm wondering what you see on the long end of the curve.
So
Maybe
you
TLT. Do you use
TLT,
TLT
sure,
as a
sure.
proxy?
Yeah, TLT is a good one. So let me just go to the weekly chart, and we had actually been extremely bearish on the bond market, and now what's going on is a very bearish occurrence, and that is, and I'm just going to show you these last several cycles right in here, and you can see the alignments of those cycles,
Yeah,
and
tight.
where there's an important bottom that occurred right over here. And
Yeah.
when you get that kind of a bottom and a rally that breaks down, that happened right over here also near the peak, where you have, this translates way on the left side of this cycle. It says that there is a lot of downside risk. So this would, project out to maybe a short-term bottom in the bond market coming in sometime in November. But
Interesting.
then
Okay.
rally attempts that really don't go anywhere. So yields could actually continue on the upside all the way into next year. This goes out to August, where that bigger cycle aligns. So we really think that, outside of minor tops in interest rates, the Fed is going to remain pretty tight. And once they get to a level of where they're finally pausing, then it's pretty likely that you get a feedback loop and commodities will soar, and they're not going to be able to, there's no pivots coming. We're not going to see that for more than a year.
Like they just stop.
Yeah, they just stopped. 24 years. I'm going to move over to the daily chart in here in TLT. And this is really weak. Now, our momentum indicators, this is the slim ribbon right over here, is still very negative. The slim ribbon, we call it the slim ribbon PO, about to give another downside arrow. So the bond market is exceptionally weak. So
Okay.
what we're anticipating really is that when they get to a point where the markets believe that the interest rates are peaking and the Fed is done, the commodities will surge. And when that happens, this feedback loop will keep them very tight. So I think they're going to stay tight for a very long period of time. And remember, they're correcting 24 years of madness, going all the way back to, Greenspan, the leader of this activist, crazy Fed that has started all of this, and, Yellen, Bernanke and Yellen following through, and now Powell completely messing the whole thing up. So all of that means that, their great experiment, which is now ended, they've lost credibility completely, and now they have to get that back. And the only way to get it back is to wash out the inflation, which is going to take a long time to do, with both the feedback loop in commodities, which I'm sure is going to happen, and the fact that all of this embedded inflation that's in wage inflation, and the fact that the CPI, PPI, there's a ton of catching up to do in there. Because the input costs are just really they're lagging on that. They need to keep raising prices, so that's going to be a long time that it takes to wash that out of the system, and to get their credibility back, maybe years. So forget about this whole madness that they've been in and zero interest rate policy. I mean, they're pegging 2%, and they're going to go for that.
Okay. Does this mean the continuation of a strong dollar? Everything you're saying.
Well, I think the
Sure
dollar.
smacks of it.
I think outside of what I think is a corrective time coming in the dollar, I'm going to go to the weekly chart right over here. I think, you can't analyze the dollar if you're looking at it in terms of the DXY without analyzing the yen. I'm sorry, the euro, because the euro is 57% of this index.
Mm-hmm.
So you can see in here that we have a note in here for our members. The euro trough is due at the end of October. So that means that outside of some little dips in here, that's why we have this upside in here projected to the top of this fib extension, which is up near 112, out in towards sometime in October, and then a dollar pullback in here. So, of course, when you look at this, you've got to say that, there's a rough time for precious metals in here. Sometimes the precious metals do okay when the dollar is strong as they begin to anticipate a change in there. But we, all of this, I think there's a huge amount of negativity in the gold market right now. And I don't think the gold market's going to do poorly in here. Yeah, it might test that last low. But then when you look at silver and copper and platinum,
Silver
all of
looks
them,
great. I mean,
they really look like
up.
they made bottom. So I don't, I think that you might be looking at this and saying gold is in trouble. I don't necessarily think that's the case, even though I think the dollar still has time to go up. Now, if you look at this cycle way out over here, this big cycle, what this does is say, well, the dollar probably corrects out towards the end of the year. But then this is a period of huge potential dollar strength, which is very much in alignment with what I'm saying about what I think the Fed is going to do, which is stay tight.
Right.
And there's no, I mean, when you think about the fact that, the Eurozone has now just raised by 0.75 of a percentage point from zero, now they're at 0.75 of a percentage point, it's going to be pretty hard for them to do any kind of a real catch-up. There will be time periods in there when that happens, and then the euro will do better. I'm going to switch over to the euro chart right over here. What do we have here? It's EUR, US dollar. And in here you can see, well, this is where we're projecting the low out towards the end of the year for the euro currency. So there's the earliest low is maybe out in around, let's say, late November or early November. That peaks, that's with that time period that the dollar can peak. So there's a lot of time frame in here, and you could see what happened. It got right up to the sell zone and backed right off. So the euro is going to have a very, very hard time getting any real upside traction right now.
Until
you can
late
see
November.
Yeah, and see this pattern right over here. This is a megaphone pattern that's, and I heard you guys talking about the fact that the euro is actually showing great strength. In fact, look at the cyclicality in here and how these cycles match up so perfectly. And right now it is trying to make a short-term bottom right in here with that megaphone. And you'll notice the negative momentum here, where it was red and now has neutralized. This is really saying to me that, the dollar is probably going to have a minor correction out over here. So this period out in here, interestingly, that September 26th date comes in again, is probably a point where the dollar is going to have a minor pullback. And maybe that's a point where gold can get away from this trouble area out over there into October. I'm looking for an October uptick here in the metals. I'm jumping all over the place, but the correlations are so important.
Okay, interesting. I know a lot of people that, like the market, we're looking for a seasonal decline starting this week into early October.
Which market are you referring to?
Mainly S&Ps.
Oh, okay.
Guys like Larry Williams, Mark Newton, they had some negative cycles mid-month until early October.
Mm-hmm.
So,
well, I mean, Larry Williams is great. I mean, they really respect him. So it's kind of in alignment with what we're saying right here.
Yeah. Larry says, as traders, Steve, we live in the future.
Yeah, that's right. And if you're a trader living in the past, you've got a lot of problems.
Oh, especially with my past, Steve.
Yeah.
You couldn't imagine. Yeah. So anything you want to wrap it with? As everyone could see, Steve does very intricate, eclectic type of analysis, and I look forward to seeing it.
Yeah, credit also to my team. We have 4 analysts here at AskThem, all working on the cycle analysis, and each one with kind of different specialties. So We offer a huge amount to our membership, and just a little promo. AskSlim.com is where you can see all of our 5 different membership levels, and there is a workshop there that you can actually take to learn cycle analysis. So I think if somebody learns a style of analysis, it's like in their blood. They never look at charts the same, because essentially we get a good sense for money flows, and you look at the different time frames to be able to really understand the messaging from the market.
So would you say that you pretty much come from a GAN perspective, that time is more important than price, like knowing when these cycles are peaking and
we don't really
bottoming?
We don't really align with GAN, but yes, there are very few styles of analysis that show time and price.
Right.
And of course, this is one of them. And I can't even imagine trading without a real good time perspective. I mean, especially if you look at a chart like this of the S&P 500, that, I mean, you can see the cyclicality in here is just incredible. Where you see the energetics in here. That, remember, this is just money flow. It's money moving in and out. And if it keeps moving in and then moving out at lower levels, well, that's your trend and the downtrend. If it's moving in and out at higher levels, like, well, you saw way back over here, that's an uptrend. And you can see in here where our Slim Ribbon PO, which is our momentum indicator, it's proprietary, fantastic. This is all green, and it gives all of these upside signals in there. And it tells you that the market is likely to resume on the upside with positive momentum. And then you can see in here where it's red and telling you it's resuming on the downside. And you can see we just had that negative resumption signal right in there, and we're still in negative conditions of momentum. And that really is important to look at. Money is flowing out right now, even though you get these big upside panics that just don't last, because the intensity from the longer term is very, very strong to the downside. And that's
okay, and I also get from you, Steve,
times.
that despite everyone looking at that 1680 breakdown level on gold, that you feel that this wherever it stops is going to be a pretty good position type of trade.
Yeah, because if you look at the cyclicality in the gold, and I'll just look at this downtrend right in here, you can see the energetic where the money moves out in here towards the end of these cycles. And you can see in here, we're getting to the end of that right now. So were that to just, test or break down that area of that low, it would say to me, big deal. I mean, if anything, it's more of a capitulation area and likely to get a rally, especially with the other metals really strong.
Yeah, I mean, silver, gold could do that, break down, and silver looks like all it would do is retrace.
Yeah, I mean, if you look here, I have the silver money flow cycle overlaid on here, and where silver made its low was right over here.
Yeah.
And gold is in a out of phase cycle with silver right now. Mostly they sync up, but this is a time when they're not. And you can see where silver got strong right in here, and much stronger than gold makes sense based on this, on the money flows. So
plus there was on the gold silver ratio, I don't know if you follow it, but there was massive divergence at 95. So that's when you could have gotten, for 1 ounce of gold, 95 pieces of silver.
Yeah, I look at that now and then, but not regularly. But that makes sense to me. So
okay,
right,
all right. Well, I think I picked your brain for what I'm interested in here, Steve, and what I believe our audience would be. You want to wrap it with one more?
Well, I mean, we could certainly go back and look at the NASDAQ, which is, I think, important also, because the NASDAQ is weaker than the S&P 500. And here you can see we're projecting the NASDAQ to get down, at best, down to about 11.6, again, in this very, very weak area right over here, with momentum weak and signals continuing to tell us of downside momentum. So I would say that when you look at the NASDAQ on the daily there, and you look at the NASDAQ here on the weekly, again, we're getting into final stages right over here. So they're both in a period where hard declines can come. And then again, we get a rally out over here in towards the end of the year that sets up what I think is another big bear market leg out into March. So I think, that's a good way to wrap it up and say, don't get fooled by what people will think will be a bull market resumption. There is no bull market resumption coming in here for a long period of time. because the fiscal flows of money and the money from the Fed are gone.
Okay, let's Steve rests his case. Looks like there's some capitulation coming in gold in the market within kind of the same time frame.
Correct. I would say
how many
that's right.
years of a bear market are you looking for, Steve? 3?
Well, there is a repeating cycle that occurs on the quarterly chart that is about 7 years long. And,
Okay.
I equate this period to the 70s,
Okay.
or, where we went through like this all through the 70s, all the way to 82. So that 7-year cycle would begin again after this low, let's say in March. So 23, that would take you potentially out to 2030 as this long period of secular bear. And I think that you'll have good cyclical bull market moves during that period, but overall just a very, very long corrective period. And I think the buy and hold people, the 60-40 investors, are going to have a lot of problems in there because bonds and the stock market are resynced.
7 years of plenty and now 7 years of naught.
Yeah,
sounds like
big
a number
big
I've
range,
heard
I would
before.
say. Easily 3,000 to 4,500, 4,800 on the S&P 500.
Got you, buddy.
Right.
Okay, my trading warrior, Steve.
Yeah, thank you.
And Steve Miller, and Ask Slim at Ask Slim, and your website address, Steve,
is www.askslim.com.
And learn cycles.
Absolutely.
Another quiver, another arrow in your quiver. So
and you'll never go back.
And I'm glad you guys are over it and mending, and really appreciate your sharing, giving nature, Steve, to come here and share your work. I know a lot of time and energy goes into it. Thank you for being a giving person and sharing it with us.
Sure, Dale. Good to be here. See you next time.
All right, everyone. Follow him at the minimum on Twitter at Ask Slim. Okay.
Right.
And check his website out. Thanks, Steve.
Thanks, Dale.
Have a great fall trading season. Talk to you down the road.
You too. Bye-bye.
Bye-bye. Okay, everyone, that's a wrap. And you could join the team in 20 minutes for the morning edge. Good hunting today. And we'll see y'all tomorrow. Thanks again, Steve.
Okay, bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.